Hello, all. It is that time again. Stuff going on in the market, and I thought it made sense to bring you all in and provide a little perspective and thought. Many of you remember going back 3.5 years ago, market had gotten a little bit ahead of itself. I felt very strongly that inflation was not going to be transitory. And so as I do, I look back to history and said, if I can find times similar to this, what is most likely to perform well, and what are some things that we may want to avoid or take a lower exposure to. Earlier this year, we got that little, what I called a tariff tantrum. Real quick 20-25% pullback. But saw on the horizon the potential for the Fed starting to lower rates and really starting to see a lot of money getting spent on AI. I don't know how soon we are to AI being fully integrated, but it's a multi-year story. So a lot of the efficiencies and productivities that are going to be there, are not there yet. But I thought there'd be some positive momentum from the story. And I think my specific statement to you, Matt, was buy. And so here we are, almost exactly 7 months from that statement. And obviously buying would have worked. But today I'm going to talk a little bit about, or a lot about, has the market once again maybe gotten ahead of itself? And a phrase that I often use is sometimes the market giveth and sometimes the market taketh away. For those of you who don't know who I am Rob Koscik, and I am the founder of DLAK Advisors, and I'm joined by Jason Phipps and Matt Ringle, both managing partners, with our take of what investors need to know in this market update. Matt, if I'm going to start with you, pick it up and talk a little bit about valuations, because I think that's a heavy component of the message today.
Yeah, and I think where we really need to start from that perspective, Rob, is defining what we use to track valuations in the market. And that would be one ratio we use is known as the Shiller PE ratio. Some out there may recognize the name from the Shiller Housing Index, which we'll touch on a little bit. I'll give you more background, but we really use the Shiller PE ratio to determine how expensive the stock market is by comparing current market prices to their average inflation-adjusted earnings over the past 10 years.
All right. So for the audience, why don't we start by talking about who is Robert Shiller? And what is the Shiller PE, and why is it so meaningful?
Yeah, so why do we even care about Robert Shiller in the first place? So he is an academic from the University of Yale who was made famous in the late 90s and really the beginning part of this century for some unfortunate right reasons, right? And those two reasons would be calling the peak of the stock market in the 90s. Some may coin that as the dot-com bubble. And then he also called the peak in the housing market in 2007, which we know what followed after that. So the Shiller PE ratio is used to wipe out really short-term anomalies, right? If we were to use a traditional PE ratio, it just takes historic prices divided by historic earnings. Current prices divided by current earnings. Okay. The idea with the Shiller PE ratio is to eliminate some of those anomalies. And so what it does is it takes prices divided by the last 10-year average earnings. So we get a little bit more recency effect with it. But the other reason we like it is because a lot of the talking heads on stations like CNBC and things like that will try to manipulate the current PE ratio, which cannot be done with the Shiller PE ratio.
Yeah,
because of that average.
Yep. Because the anomaly is that you see is if you see a period in the past, then I mean the long past, a lot of people are not familiar that you would often see very low PEs when things were good. and you would see high PEs when times were bad. So people actually were taking the right things into account, going, well, if things are very good now, earnings may not be so good in the future, so I shouldn't be willing to pay a high PE. And so what happens, though, right now is you have historic profit margins, historic spending that is taking place. All those things do is they support earnings.
Yep.
So by taking out the current earnings and smoothing it over 10 years, you really take out the anomaly and you really get a great historic effect on how inexpensive the market is at a given point in time.
Yeah, well, and I think that's what makes this ratio a little bit scary when I say it, but on a historic basis, this Shiller PE ratio, it's now it usually sits at about a 17. Now it's over double at 39. So the only times in the past when we've seen valuations this high was during the dot-com bubble in the late 90s, and then briefly before 1929. Both of those situations came with large, significant pullbacks after we saw the rise in valuations.
As always with these speeches is that I'll bring visuals. And so we had some visuals prepared, but some of the things that I'm sure that I'm putting up on the screen now, or my staff will be putting up on the screen while I'm speaking, is from an article in the Wall Street Journal today. So they must have found out that we were doing this and they wanted to provide some visuals for me. But literally it talks about Robert Shiller and the Shiller PE. But it also does is it says, based upon the CAPE, the Shiller PE, it projects what you would expect the next 10 years of returns to be. So the two charts that I'm sure that staff is scrolling through at this time, one is showing where's the Shiller PE today versus where it has been historically, and it is now, unfortunately, on par with the internet bubble. Yeah. And two is the projected 10-year returns if these valuations were to get back in line over the next 10 years, which unfortunately says that our future expected returns are very, very, very likely, if history repeats itself, to be much lower than we've experiencing of late.
Well, there's other metrics too that we use, not just the Shiller PE ratio, and a common one that we will use is the price to sales ratio. So, when we're looking at that, that's determining stock price over the company's sales, what's driving its revenue, in other words. And when you look at that, the stories kind of along the same lines of what we've been talking about is the technology sector, which holds some of these larger names with the concentration in the market. It's now climbed near 10, which is an all-time high.
And I show the chart is showing right now, from 2009 to 2018.
That's right.
Where did it spend most of its time then?
Spend most of its time
between 2 and 4.
Between 2 and 4.
Yeah. And if you went back and did not look at the late 1990s, during most times, that's where it's going to be. So if people want to get on TV and talk about now is different, there are certain components of the market that is different about technology stocks. These companies are stronger, safer, more reliable in their ability to produce cash than ever before. But valuations over the long term have a heavy, heavy influence on what your long-term returns will be. But hopefully we'll try to take this term long-term and as much as we can relate it back to today. Jason, I know there's some things that you wanted to talk about and how we got here.
Yeah, I mean, this hasn't happened by accident. It's not a random act. There's really been three main components that have driven the stock market valuations to where they are today. The first, Rob touched on, AI investments. You have large corporations that feel that this AI race is a race they cannot afford to lose. And they've been spending money at elevated levels for years to try to win that race or at least compete in that.
Some of the announcements later from OpenAI giving this firm 10 billion, Oracle 100 billion. I mean, it's just crazy.
Yeah. The other
it's hard to digest, but I guess it's good in the short term.
It is, and you would think with the extra spend, the investment community expects a return on that investment of spend through productivity gains. And the other piece that's interesting is profit margins are near all-time highs, even with the AI spending. and AI's not fully baked into the equation yet, as we've said earlier. But many of our peers would point to profit margins and a mean reversion in profit margins as being, quite simply put, if we have mean reversion in profit margins, it's not a good thing for stocks. And finally, interest rate cuts. And all of this has resulted, if you look at the ACWI index, which is a global stock market index, and you look at the performance from April of 2023 through October of 2025, we've seen a 17% per year average annual return on that index.
And we've seen the same from April of 2020. So I don't know if it is also just, a coincidence, but if you look at the last 5.5 years, the global stock market index has averaged 17% per year. Yeah, that's not normal. Let's put that into context for everybody. That's not normal. That's where phrases like the market giveth and the market taketh away brings us in front of you today.
Yeah, so I guess the bull run has been a powerful one. But at current levels, the market valuations leave us susceptible to a pullback and possibly a meaningful pullback.
All right. Well, history doesn't always repeat itself, but it often finds its very close cousin. All right. Every market valuation peak has shared the same DNA: optimism, FOMO, and the belief that this time is different. So I went to my staff about a month ago and I said, all right, if I'm going to make some type of macro call, and nobody can make a macro call in, especially from a peak standpoint, in a vacuum, or what I mean is in a short period. So at least give me some leeway to know that we're talking intermediate term here. So this is the research that I had them do. I said, all right, I'm going to propose a thesis, and that is that every time that market valuations have gotten anywhere near where we are now, and let's call it the top 10 or 15%, the most expensive stocks have been on a price to earnings, price to sales type basis. All right. I want you to find each of these, because I believe very strongly that in every instance that it was prefaced with people enjoying significant excess returns beyond norm. And unfortunately, it culminated in a correction or crash of 25% or more. Okay? Well, came back because you're seeing the numbers on your screen right now, but I think there were 9 instances going back to the Great Depression where we saw a short period of time, somewhere between a couple of years and 5 years, where the market far exceeded its historical norm. And in every instance, we saw a significant pullback. So if anybody's going to ask, hey, what is it that's going to cause it? I got the answer for you. I have no idea what's going to cause it. Okay? All right? Because ultimately, one way that I phrase things is that you're going to wake up one day and go, and the market's going to be down 10% in a couple of days. And you're going to look at valuations and go, how in the world do we allow ourselves to get here? And that's when you're really going to know that there's a lot further on the downside from here. So once again, in terms of giving me some leeway from an intermediate standpoint, I'd sit here today and say it's very, very likely from the research that we've done, almost near 100%, that we should have a 25% or more pullback in the next 18 months or 24 months. Okay? What's going to start? Once again, I have no idea. Momentum is a very powerful thing. And so all I can think of is an example that many of you have heard of. I assume that most of you have heard of a gentleman named Mr. Alan Greenspan, who coined a phrase, irrational exuberance, in the late 1990s, in the throes of the magnificent tech run. Well, he coined that phrase in December of 1996. Markets didn't peak until, in December of 1996. markets didn't peak until March of 2000. All right. So momentum can extend further. So since nobody can market time, here's where I'm going to take you to what I'll talk about, a conclusion from a market standpoint. From a market standpoint, I'm going to put us all into segment you all into 4 categories. All right. One is, regardless of where you are, we highly encourage you not to time the market, which would mean, I'm going to move more than 20 or 25% of my money to lesser risk or more risk at any one given point in time, because nobody has a crystal ball. All right. Now the segmentation. 1, if you're under 45 years of age, and the following statement defines you: majority of the money that I will historically invest, I have not earned yet. If that's you, any market correction is not a threat. It's an opportunity. Lower prices mean better entry points. Okay? Another segment. If a majority of your money is in after-tax accounts, and/or you see trying to find the bottom or top overwhelming, we will continue in the most tax-efficient manner to take our responsibility of maximizing our clients' profits and minimizing their downside as important as we ever have. But one of the key terms there, from what I said before, for majority of the money is in after-tax accounts, we'll do it in a tax-efficient manner. Market timing is hard enough without having to take a 20% haircut in pulling out of the market. Because if you're taking capital gains, many of my clients are not in a low tax bracket, so they will see them paying 20% or so on their capital gains. Okay? So in that particular instance, there could be some minor moves, but, it's all about the tail and the dog. I'm not, is in this particular instance, I often will allow the tail to wag the dog because I don't want to take a 20% haircut to try to market top. Now, to a majority of my clients, a majority of my clients are not under the age of 45. In those instances, what I preach is there are 2 times when one should be considering lowering their exposure to equities. One is, am I getting older and closer to needing to supplement my income with my savings? All right. And when I say closer, I mean relatively soon, or what do you mean? Am I near? I've been doing it for years already. Okay. And the number 2, the market is near historic highs. All right. Here's one thing we know. I am older now than I was at the beginning of the taping of this. It's true. So we're always getting older and nearer to needing our money. And 2, on a valuations perspective, market at historic highs. And the very fortunate part that I not only say that, I say, if I've gone through a period where I have experienced excess returns beyond what I normally would have expected. Right? There's a phrase out there, nobody ever got poor taking profits. All right? So those are some things that we're going to have to be taking into account. So whether it be something where we've spoken over the past month, or we're going to speak in the next few months, because we're always talking with our clients at least once every few months and having a meeting. This is not something you need to run out and call us about in the next 10 minutes because something's going to happen tomorrow. Okay. This is something, like I said, it's probably going to be sometime in the next 18 months or 24 months that we will likely get a better buying opportunity that exists immediately at this point in time. Okay. And fortunately for you, you have people like us who know what we should be doing with that money in the meantime, because sitting in cash is also never an answer. All right, Jason, we've had a little fun at DLAK with gold over the past few years. We took a very significant position in gold across our clients before, when inflation started rearing its ugly head about 5 years ago. This year has been fun. You want to talk a little bit about some of the talk on what's driving the returns in gold?
Yeah, there's a lot of different camps, but the message on gold's been pretty loud and clear this year. We're at about $4,000 an ounce, highest level on record in real terms. Often you'll hear about smart money in the market being attributed to the bond market, and just because the institutional investors control that market. And yet we've continued to see flows going into gold, driving the prices higher and higher. So there is a camp out there that would attribute gold's rise in prices to currency debasement. And it's really hard to fully agree with the debasement camp, because you would expect if you saw currency debasement, we would have much higher yields, as you would have the investment community would be giving up or going away from the dollar.
And auctions wouldn't be going so well.
Correct. Yeah. So demand would be impacted as well.
So they'd be demanding those yields. That's it. They'd be demanding a higher yield or a lower price, which are two things that are really not happening.
Yeah, and if you're right, so it can't be fully debasement. If you look at all the other,
That's funny. Debased. I keep thinking of my daughter. It's the basement. But that's how when she was young, called the basement. God.
The other things that you would attribute gold's growth to would be global uncertainty, inflationary pressures or inflationary hedge, and FOMO. After something's risen in price and it's been followed and talked about, you have the FOMO trend. And I would say that it's likely that all of those are right. But if I'm looking at where gold is at current levels, my theory would be that the largest driver of that right now is FOMO, followed by debasement. I mean, the United States is running a deficit of about 8% of GDP. France is about 5.8% of GDP. I know you did a podcast either late last year or earlier this year where you talked about Secretary Besant's goal of getting to a 3% or less of GDP.
I was hoping at the time. Okay.
Which would be, I would be in favor of. I don't see the political will to get it done.
It's a noble goal, I would say.
Yes. But and you've heard Rob say this. Our conclusion on the topic is that deficits just don't matter until they do. And when they do, unfortunately, there's not much that can be done to correct the issue.
Matt, to refresh the audience, what are the themes that we follow that help us make decisions and hopefully timely decisions?
Yeah, I know we've talked really about two of them, or we've alluded to two of them so far in the video. The number one is valuation metrics. So as we talked about tracking the Shiller PE, the price to sales, seeing where that lies versus its historic relationship. The other one is momentum, which we've talked about kind of in the term of using FOMO is what we've said.
What is, so if anybody doesn't know what it is,
Fear on missing out, is what FOMO stands for. And so that could really be
everybody else is making money, so I
have to jump in, right? Yes, exactly.
And then you're the last one holding.
Yes, holding it too long. And so you have the momentum, people wanting to get in with things going up and trending that way. And then you also have macroeconomic trends, easing inflation, potential rate cuts, may prolong this rally, but those are already, I think, for the most part, largely priced in. So the next meaningful pullback will likely reset valuations and set up the next wave of opportunity. But that only helps if you have the liquidity to be able to take advantage of it, as well as the plan and the mindset. And that's really where, working with individuals like us helps.
Okay. So if everybody just reflects to the recent past, most of the corrections that we've experienced of late have been meaningful and quick. The tariff tantrum earlier this year.
Mm-hmm.
Okay. That at most was a couple of weeks, and most of it happened within 1 week.
COVID 2020.
COVID 2020, more than a 30% drop, all intra-month.
Yeah.
All within March, of 2020. So in that instance, I would say markets have rewarded patience. And the patience being is that I don't know when the market will reset its valuations. But if this is something that you think relates specifically to you, you're closer to needing the money, and you know what? You've made a lot more and you'd like to keep that, I'll go off of, many of you may know the name Andrew Ross Sorkin. Okay. Everybody, I'm sure, knows that I'm a religious watcher of CNBC. I wake up in the morning and the first thing I do is I put on CNBC. And Andrew Ross Sorkin is what I would consider to be a relatively younger gentleman, but he's a relied upon historian already. And he was on 60 Minutes just a couple of weeks ago. And so Leslie Stahl was interviewing Andrew Ross Sorkin because he's writing a book called 1929. And ultimately, the discussion was about valuations and an inevitable crash. And so Leslie asked Andrew, will we have a crash? And he said, Leslie, yes. I just can't tell you when or how deep. Okay? So the point isn't fear. It's preparation. The market giveth and the market taketh away. So nothing here today is meant to elicit fear. It's all about doing what we've always done over the 20-year history of DLAK. Is the market gets cheap, we'll allocate more to stocks or to risk. Risk on. Market gets expensive, risk off. And how you do it appropriately over time, and just be aware that the second part is not only one part of this, because in many instances, some of you may want to get back in. And so it's a process. So I always appreciate you all taking time and listening to our thoughts. And I look forward to seeing you all and talking with you soon. Have a good one. For all podcast-related questions, or if you are a media group and are looking to be on the podcast, or would like the Wealth Whisperer on yours, reach out to DLAK Advisors at DLAKadvisors.com. Please visit our video description for helpful links. For all questions or inquiries into the services that are provided by DLAK Wealth Advisors, please contact us at elliot.singer@DLAKadvisors.com. That's Elliot with 2 T's.